Hi there, welcome to Kneppy Invest. In today's video, I'm going to go through the financial year report and numbers for a company called Korvest. Now, one of the reasons I'm doing a standalone video on this company and why I did a standalone video on this company 1 year ago is because typically, and maybe not typically, always this company is the first to release their financial year results. In fact, this year, they released their financial year results on the 24th of July, significantly earlier than everyone else. I think the next company that released their results was the last day of July or maybe the first day of August. And most companies tend to release their financial year results towards the end of August, not towards the end of July. So I'd like to reward Korvest as being the first company to release their financial year results. Now, Korvest is all about galvanizing and selling of cable and pipe supports. The Easy Strut brand, which is selling cable and pipe supports, is by far the biggest side of the business. They also have Korvest galvanizing. And every single time I hear or see the word galvanizing, I just think of Galveston, that famous song, Galveston, oh Galveston. But I also think of the hurricane of 1900 that absolutely destroyed Galveston. At that point in time, it looked like Galveston was going to become the biggest city in Texas, but that hurricane in 1900 destroyed that thought. And in fact, there was a really good book called Isaac Storm in relation to that hurricane. And also, the hurricane of 1900 that actually did destroy Galveston is the deadliest natural disaster to hit the United States in history. Well, in recorded history anyway. So Easy Strut, Korvest galvanizing, and probably the other thing to notice about Korvest, this company has been around for a long time. In fact, it listed on the ASX in September 1970. So we're talking about 53 years as a listed entity. Yet, even though it has been on the ASX for 53 years, this company has a markup of less than $100 million, which should show you that it is really hard to grow this company. And that's why some of the valuation metrics for this company look really attractive at current levels. We'll talk about that in a second. This company is headquartered in South Australia, primarily in Australian business. They also have an office in New Zealand. It also said here, overseas supply chain provides make versus buy flexibility. Don't know what that means. Anyway, on to the headline numbers. The whole reason we're here is to look at these headline numbers. So keep in mind, the markup of this company is currently, according to Market Index, $95 million. So keep that in the back of your mind when we look at some of these numbers. Also comparing to financial year 22. So revenue up to $107.5 million, which was a record year for this company. In fact, it might be the first year that this company has seen a revenue above $100 million. That was 8.3% higher than last year. Unfortunately, margins have contracted. That means EBIT relatively flat at 16.1 million, profit down 1.4% to 11.2 million. Operating cash flow, however, up 274.4%. I'm a little bit surprised they're just not pointing that out. The first thing I should mention is operating cash flow up 274.4% from 4 million to 15 million. Now, the reason why operating cash flow is up 274.4% is because of changes in working capital, particularly in inventory. This is fairly important. In 2022, they decided to increase the inventory, and to increase the inventory, they have to spend money. And this year, they decided to decrease the inventory, which makes sense. A lot of retail companies actually have done that. And when you actually decrease your inventory, there is a change in working capital, and that actually increases your operating cash flow. That's why there is a significant increase in operating cash flow. Doesn't mean it was a much better year, financial year 23, than 22. So I always have to keep in mind changes in working capital when you look at changes or increases or decreases in operating cash flow. Earnings per share, just under $1 per share. So remember, this company has a markup of 96 million and a share price of $8.18. So earnings per share, just about $1, which means the PE ratio of this company is well under 10. Say that again, well under 10. Now, this company has been growing not only their sales, but also their profit over the past 5 or 6 years. And if the company can keep on growing like it has over the past 5 or 6 years, this company is ridiculously cheap right now. Not only that, dividend per share is 60 cents. So the dividend yield of this company is quite attractive right now, where Not quite at 10%, but definitely around 7, 8%. Now, there are reasons, and I'll talk about the reasons why you do have to be a little bit wary about this company, particularly when you look at the history. And keep in the back of your mind, this company has been around for 53 years on the ASX. Now, if you want to break down the revenue by the divisions, EasyStrut, by far the biggest revenue producer, $97.7 million EasyStrut, while the galvanizing side of the business only produced $9.8 million. They also, if you want to go through the presentation, they talk about some key initiatives, also some outlooks, that sort of thing. So I do recommend, if you want to do more research on this company, go through their presentation. Now onto some interesting things when it comes to this company. So one of the things I always like to look at, first of all, when I am researching a company, is revenue growth and also gross margins, that sort of thing. So what I provided here through Ticker, T-I-K-R, is their revenue, annual revenue history over the past 20 years. The main thing, I'll just actually go into full screen here. The main thing I want to see when I look at revenue history is it going up through time. So over the past 20 years, it has definitely increased through time. In fact, it's doubled from $50 million in 2004 to over $100 million in 2023. But you'll notice there was a period of time in the past 20 years, between 2014 and 2017, when revenue dropped precipitously from 74 million to 44.7 million. And during that time as well, gross margins significantly dropped. So not only do I have the revenue on this graph, I also have the gross margins. So two concerning things just by looking at this. This company is cyclical. There are things that affect the performance of this company, which I'll touch upon in a few minutes. And those negative things, those headwinds, affected the performance of this company during that 3 or 4 year period in the middle of 2010s. But the other really concerning thing is around gross margins. So before 2015, gross margins of this company were consistently above 40%. And then the bad times happened between 2014 and 2017. And ever since then, gross margins have been consistently below 40%. In fact, over the last 3 years, gross margins have been around about 36.3 to 36.5%. So even though revenue has been growing, gross margins have not. So I'd like to see a little bit of growth in gross margins. I'd love to see gross margins get above 40%. And also, I'd love to see revenue keep on climbing from here. If that happens, revenue keeps on climbing, gross margins keep on climbing, this might be the cheapest company on the ASX. But I am a little bit wary because this company has been around on the ASX for 53 years. Now, one of the things I wanted to find out is what caused those headwinds back in 2016 and 17. So all I did was I went to the Korvest page on Market Index, went to the announcement bit of the page, and you can see all the announcement this company has released since 1998, if you're that key. Not all the way back to 1970, but 1998. So I wanted to go back to 2017. And I actually do or have brought up a couple of their announcements. This is the chairman's address to shareholders in 2017. You also can look at their full-year report, the financial report that year, and you can get a lot of information out of this. For instance, in the chairman's address, they mentioned a few things. Today, I will be reflecting on the 2017 financial year, as well as giving an update on the current trading conditions and focus, blah, blah, blah. But he mentions here, in industrials products, the EasyStrut business endured a difficult operating environment. And this is the most important thing. Why was it difficult? The competitive landscape. So a lot of competition for cable supports continues to change with new entrants and cheaper imported products becoming more prevalent. Overall market activity was subdued, particularly in the mining and oil gas sectors, with signs of improvement developing during the second half. They also talk about pricing issues. So EasyStrut was also faced with significant input cost increases, with steel increasing up to 44% through the year. In addition, electricity costs increased between 108 and 179% for the whole of the second half. It was difficult for EasyStrut to pass on these input cost increases in such a competitive market, which resulted in reduced margins. So we get a clear picture of the significant headwinds that can affect this company. So we're talking about competition. We're also talking about increase in steel prices and electricity prices. Also decreases in stuff like zinc will affect the performance of this company as well. So even though This company has been performing really well over the past 5 or 6 years. I think the market is a little bit skeptical and wary that this performance can continue in the next 5 years. And that's why this company looks ridiculously cheap right now. So a few other things I like to look at, and this is from Guru Focus. I like to look at revenue growth per share. 1.7% over the last 10 years, 13.3% over the last 5 years. So the last 5 years has been really good for this company. Dividends have grown 45.7% over the last 5 years because things have been going along really well for this company. Total return, 36.8% over the last 5 years, 12.8% over the last 10 years, 21.8% over the last 1 year. So if you just look at total return, this company looks like an amazing company to own your portfolio. Not only that, return on equity, 24.4, that's pretty good. Return on invested capital, 18.3, that's pretty good as well. But if you look at the history of return on equity and return on invested capital, typically those two metrics are below 15. It's only been the last 2 years that it has trended higher than 20. So there is potential if they can't maintain those metrics above 20, this company could struggle in the future. And maybe the decrease in gross margins we have seen and the net margins we have seen in the past year is possible sign that this company is starting to feel a little bit more pressure. So what's the dividend yield? Dividend yield, I think we can get that through. Where's the dividend yield here? I'm trying to find the dividend yield. Should be somewhere here. Should be on Guru Focus. Actually, you can see this by, I could either do it through ticker. Dividend yield is 7.3%, so about right on. It's right on there. And the return on equity, not return on equity, the PE ratio, I can see that on Guru Focus, 8.6. So PE ratio of 8.6, dividend yield above 7%. This company looks quite attractive now. But again, the one thing that concerns me about Korvest is increased headwinds over the next few years, because I don't think these good times will continue over the next 5 to 10 years. And that's one thing I think the market is a little bit wary about this company as well. So that's really all. Actually, I'll show you the chart first, or last of all. So this is Korvest's daily chart. Nothing too exciting. If we look at the weekly chart, we can definitely see a down period. Share price got as low as $2 back in 2016 through to 2018. In fact, $2 was a nice little floor on the share price. But you can see when this company experienced some downtime, some bad times, the share price absolutely fell off a cliff. In fact, share price dropped from $8 all the way back down to $2. And the share price has recovered back up to the levels this company saw back in 2013 when this company was performing really well. So if you just have a look at the weekly chart, you can see that this company is definitely cyclical, and maybe this company is at the top of its cycle right now. So that's all I want to say about Korvest and their financial year 23 results. If you have any questions about Korvest, if you are a shareholder of this company and you completely disagree with me, if you think this company can keep on growing like it has over the last 5 years, I'd love to hear your opinion. So leave your thoughts in the comment section of this video. Otherwise, I'm not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.